Well, happy Thursday morning, everybody. Welcome to our long verticals and diagonals webcast. This is Connie Hill, Senior Manager here at Schwab. You know, you guys asked some really good questions in this session about details of some of the trades we've been doing, and in particularly diagonals. In fact, I had a couple of requests come in that we're going to address today about diagonals, and hopefully by the end you'll feel a little bit more comfortable with them. We've got a lot of trades we need to review and make some adjustments to, so we've got a pretty booked agenda here today. I am joined in the chat by Barb Armstrong, good friend and fellow coach. Barb's a great veteran of the markets. I know tons of you love Barb's classes, so I'm happy that we have Barb here. She'll try to catch some of those questions I can't quite get to, but I'll keep my eye on the chat. She'll keep her eye on the chat. As you do have those questions, let us know. If you are listening to this on the recording and you have a question, write it in the comment section on YouTube. That's where we pull this information from, right? These questions that we're looking at here are some of the things that you guys chatted in about. So please do so. Now, I hope you're following us on X. I'm Connie Hill, CS. Barb is Barbara Armstrong, CS. We'll post educational content, things we're noticing about the markets. I have a tendency to show you some scan results and some charts quite frequently. So they're just little nuggets that you can get along the way during your trading week. Well, let's do this. Let's go through our disclosures and get down to business. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for information and educational purposes. Don't consider a recommendation. We will be using the Paper Money software application. It is for educational purposes only. I think it's a fantastic tool to try out strategies. Maybe strategies you're not as comfortable with or that are new to you. Do some practice trades in the Paper Money side. Past performance of any security or strategy does not guarantee future results or success. So we are going to talk about a little bit structurally about the difference between verticals, long verticals, I should say, and diagonals. Throughout trades, we're looking at the impact of price, time, and volatility because of those are the main factors impacting an options price. We've got a lot of examples to go through, existing trades as well as some new additional trades. So let's get on with things. Let's hop on over to the Thinkorswim charts here. And I just have it up on the SPX. Yeah, the SPX has put in another new high. Look at that. We're witnessing history here. 7,500 is the current new high on the SPX, and that was this morning. In fact, just a little bit ago. It's still, I think, grinding up a little bit in that endeavor. Let's see if the NASDAQ is still holding up here. On our NASDAQ, another new high. Look at that, 29,627. We are knocking on the door of this 30,000. I remember it wasn't too many years ago we were knocking on the door of a Dow 30,000. And now we're sitting here at a NASDAQ 30,000. That is just wild. Now on my chart, I have a blue line that's a 10-period moving average, simple. And then I have a 30-day simple moving average here. So we get an idea of what the short-term trends are, what the intermediate trends are. Well, with both of those major indexes being up, what do you suppose the Russell is doing? Russell's up 0.5% as well. And the Dow Jones looks like it's having a nice move. Actually, it was up earlier today, and it looks like it's holding on to the gains that it has there. And it's approaching its all-time high of 505, but we're about, a little bit below that, so 5,000 points. So we'll see what happens if it really breaks out, because it's kind of been stuck in this little bit of a range. Depending on where you draw your line, some people might consider that a breakout today. I'd say I would say it's trying to break out. I wouldn't say it's definitive yet. Okay. If all the indexes are up, what should be down? And what should be down is implied volatility. Technically, it's up a little bit. Now, remember on the VIX that it's the ratio between calls and puts on the SPX. And so sometimes it doesn't go tick for tat necessarily of what the indexers are doing. The fact that it is up a little bit could indicate there's some more call buying versus a lot of put buying. Okay, so that's what we're looking at here. Let's see. Or somebody saying Oracle looks beautiful. Oh, that probably does look beautiful. It's not on our agenda, but let's start going through the things that are. One of the questions that one of you chatted in, and I can't remember if it was something in our last class or if it was just in the comments since we have met last time. And it says, on this other program, they have the ability, they have a little tool that tells you how many stocks are above the 40-day simple moving average. Does Thinkorswim have something like that? And the answer is yes, it does. I'll show you two things here. And these, if they're not familiar with these ticker symbols, you might want to write them down. First one is going to be $SPX, and I'll start with the A50R. SPX A50R is a representative of how many stocks are above their moving average, in this case 50. Now I don't have a 50 on the screen, but what it's showing us here, the actual number is 0.477. And it's also kind of showing right up there. So that would mean 47% of the SPX is above its 50-day moving average. Okay, so kind of a split audience there. The other ticker symbol, we're just going to change this out, is instead of the 50, we're going to put in a 200R, SPX 200R. How many of the S&P 500 are above its 200-day moving average? Value here looks like 0.53. So about 53% of them are above that 200-day moving average. If we were doing it as a pie slice, both of these are pretty close to almost even, right? 50 something, 50 something. So kind of mixed market. Not all the market is participating in this rally that we have been seeing, but we have a lot of really big names that are really pulling the markets along. A good way to see that is if you come over here in your market watch, visualize, and on the heat map, let's see, I've got the S&P 500 highlighted here. So some of our biggest stocks are the ones that are really doing a lot of moving. NVIDIA, of course, Avgo, which is Broadcom, Microsoft. Google's kind of the one pulling down. And where is Meta? Meta. Right there, Meta is a little bit green here. So it kind of gives you an idea. And then the rest of these other players, there's a lot of them are in the green. Okay, so that's one way you can kind of check. Paul says we could use the 100 in that chart as well. If we so we did 50, 200. Let's swap out for a 100. And it looks like 46% of stocks are above their 100-day moving average, which some people would consider that a longer term moving average as well. Okay, so that is one thing off of our list that some of you are interested in knowing about. Now, another request that I had come in was the request to do a LEAPS contract. This came in our chat as well as a comment. They came in afterwards. Because with a diagonal, because we haven't really gone that far out with any of our diagonal trades, and somebody would like to see that. Okay, so we will fulfill that wish in an interesting way. Let's come over here to our activity and positions, and actually let's just start on AMD. Last week on AMD, we kind of went back and we're counting through history how many puts had we sold against this long put, and what did that amount to? And basically, when we went through and added from the account statement on AMD, let's get AMD in there, and we go back a long time because we started this trade, I believe, in March. We went through and counted up all of those credits, and there was quite a bit more credits that more than offset the loss that we had in the long put. And the idea with that particular diagonal was a little bit different, a little bit unorthodox, because we were selling our longer dated option had fallen out of the money, and we could have rolled it and then adjusted that and moved it up, but we hadn't really done that because it was just kind of some cheap protection, and we just continued to sell puts against it. Well, last week, what did we do? Well, one thing I ignore this call here. That was the wrong one. What we really had is we sold a 405 put in our class last week on the 7th. Then later in the day, the stock took a pretty decent move, and we were kind of down on it, about $4 or $400 per contract. And I was like, that's just kind of eating into our profits. Let's just go close it out. So I did that. You can see just a little bit after our class, because I didn't want it digging into our profits. Well, what happened the next day, it stabilized, gave us a big pop. So I went out and said, okay, fine, we'll go sell the 425 put this time. We brought in $12.50 of additional credit. That more than offset for our, I think this ended up being like 365 that we were down on it. So that more than made up for the 365, assuming that it's been able to decay and erode. Let's look at the chart. And when we look at the chart, I want you to tell me what you think the value of our 1250 put is now. I want you to kind of be thinking to yourself if it should be higher or if it should be lower. Okay, so let's go look at the chart, AMD. I'm going to kind of zoom in here. This was, let me get it on the right date, the 8th. So this was last Friday. We had sold it in here. It looked like it was up at the time that we sold it, and that's when it really dropped down. But the next day when it flipped, we went ahead, got in again. The stock at that point ran up, and then it's kind of just been going a little bit sideways. And I think our strike price on that was 415, which is about somewhere close to where my mouse is right now. Okay. So in your mind, do you think that 1250 credit we brought in has eroded to be profitable for us? Or do you think that it maybe has just kind of stayed the same? Okay, let's go look, because these are the days when we're getting so close to the options expiration that, let's go to this one, that it's decaying quite rapidly. Okay, here is our 1250 put, which was the second one I got into. It has decayed now down. Man, we have about 90% of this now. Okay, it has decayed down to $1.24. Sweet. The net of that is going to be what? About $11.05. So $1,100 just on that one contract alone. So now we have to subtract our 365 for this little loss that we took on the first one. And then we have more than offset that. So that just basically is going to our little earnings section of all those puts that we've sold against that long put. Okay. So let me see. I don't know. You can tell yourself if you guessed right, if you didn't guess right, and just kind of maybe know what the answer is. Now, today, both of these are going to expire tomorrow. Okay. Our long option that we just keep selling against is, and it has been this way for a long time, is nothing, right? 0.005. We're not getting anything out of it. That thing is so far out of the money, that 195 put, because AMD has just been on a major roll. Okay. However, this one right here, our short leg, do we want to be risky with that? Are we willing to risk getting 10% more out of this and risk the 90% we've already banked? I shouldn't say banked, because we have to close the contract for us to really take advantage of that. Okay. Could AMD have some bad news come out? Could it drop below 415? It could. I mean, right now, the second, it doesn't look like it's going to do it, but it could do it at any time. So we're going to do the safe thing. We're just going to close out this trade and say, thank you very much, AMD. Appreciate you selling us some nice premium there. We're going to lock in those gains. This thing, we can't get anything out of it. So we're just going to let it expire with us tomorrow. Okay. Let's create that working order. Buy it back now for $1.39. So we're 90+% of that 1250. Moving around a little bit, let's come over here by the midpoint price. Let's see if we can get out for our midpoint price. Sometimes paper money is nice to us. It'll do it at the midpoint. If it doesn't do it quickly, then like it's not doing it quickly now, let's see, it's maybe we need to, oh, very good. There we go. We got filled on it. All right. That is the official end of our AMD trade that started on March 12th. Okay. And that's how, a lot of times how these diagonal trades go is they're kind of these, you're identifying something you think is trending well, and you're just continuing to play it throughout. Okay. On that one. Any questions on AMD? Ricebird says, don't risk a nickel when you may be able to get a pickle. Absolutely. CB wants to know, what was the criteria I used to sell the other strike price? Yeah, so what I decided to do, since our long leg was going to expire tomorrow, that's why I just said, oh, I'm not going to go further out. There's no need to, because we don't have protection out beyond that. So I'll just sell the same expiration month. Let's see what we can get out of it. Okay. And then as far as the strike price goes, in this one, I think I just went a little bit out of the money. When I say a little bit, I want to say maybe about $10 out of the money. I believe it was a 40-ish delta. So it was a little bit out of the money, maybe a little bit aggressive, but I knew our time decay was just going to be so rapid in that last week. So that was the criteria for that. All right. Next up, let's just take a quick look at Apple. On Apple last week, we did a long call vertical. Let's get this open so you can see it. We're up on the trade pretty nicely right now. In our position sizing, we could do 4 contracts, which is nice. Still has 22 days before it expires, so it's not out till June 5th. And we have an order sitting out here to get us out when it gets up to 823, which was about 70% of the max gain. It's not there yet. It's making a good path there. And so time decay, we'll just kind of let it work. Well, let's see if that thing can continue to climb up. Let's take a quick look at Apple. We want it to be beyond 300. And so as we look at Apple, oops. Have to get on the right keys. There we go. So Apple hit 300 yesterday as its high price. Looks like it's pulling back a little bit today. Okay, but it's right up in the area where we would love to see it be. So we're just gonna let it keep working, right? It's wonderful if it hits its target in the first week, but it doesn't always do that. But it's just, this one's just kind of a slow, steady progressor. We don't mind slow, steady progressing, do we? All right. Microsoft. This is one that requires a little bit of discussion because there were some questions about this particular setup. Now, one thing that I did is I changed strike prices from what I intended to do initially in the trade. Okay, I did that intentionally because things had moved a little bit more than I was expecting them to have moved. The thing that caused a little bit of confusion here, our longer dated option here, you can see is the July 435, but we sold a 415 call, which was actually a little bit more in the money versus out of the money. And that did create some confusion. People are like, oh, I think we did this wrong. Now, what I am going to say is that I did not do it the traditional way. The traditional way, I would have sold a little bit further out of the money than what my long call strike was. Typically you'd say, well, okay, maybe we are going to sell the 435 or the 455 or something further out than this 435. In this case, I went in, I was being a little bit aggressive on it. We did not gain that much out of it. You can see we've gained a whole $28. Oh, 34 now. And so we've got 1 day. Let's go ahead and just roll this. Okay, we're going to go sell. So we know we're going to go out to, this has weekly, so we know we're going to go out to May 22nd. Keep in mind here, 435, and in your head, I want you to determine what strike price you would feel comfortable selling. Maybe taking this back to a more traditional roll or traditional setup of a diagonal where our shorter dated contract is a little further out of the money. Okay, Go to the trade page here. And we want Microsoft. So on our Microsoft, our July option is out here. This is the one that we need to roll. And it is, oh, actually right now it's at a 33 delta. So it could expire out of the money. But in this case, typically what we're wanting to do with these diagonals that we have weekly options to trade on, typically what we're going to want to do is sell the next Friday, which in this case would be May 22nd. And then either before we get to class, I will have rolled it, or if I haven't at the time of our class, then in our class, we're going to roll that short leg so you can kind of see the process. Sometimes I have closed them out earlier in the week when we're up like 90% in 2 days. I'm like, let's sell another one. And then we'll re-examine it again in our class. Okay. They don't always decay that rapidly, but sometimes they have. And so that's the action we've done. We did that on AMD a few times because it was just running parabolic. Okay, so we're going to get out of this one. Let's go to the May 22s. And I want you to, and if you want, you can chat this in too. What strike price on the call side? We don't need 100 anymore. Let's make this a little bit more manageable. Let's go down to 30. What strike price would you personally be comfortable selling? Okay, our at the money is going to be this 410. And again, if we're being a little bit more traditional, you know, we'd maybe go a little bit further out of the money. So in this case, some people might go to a 30 something delta. They'd be happy with that, selling something that's high probability to begin with. If you want to go way out of the money, you can. Remember, the premium that you receive is not going to be at nearly as much. And this is a kind of an expensive stock, $410. So yeah, it has a lot of strike prices depending on where you have your own comfort zone. Okay, so let me just take a look here at something. Let's go. Let's go to, we'll be more traditional here. We'll go 420. It's got a 33 delta. That brings in 385 of premium. And right now, this probability right here of saying the probability of it expiring out of the money come next Friday is about 68%. So it's theoretical in nature. It's not guaranteed, but that is our probability with this one. Okay, so we're going to do the 420. I'm just going to write 420 in the margin here. And then we're going to go out to our position. We're going to do the roll. Now, really, the roll is just doing it all at the same time. If a roll confuses you, you don't have to do it that way. If the roll confuses you, you could say, okay, I'm just going to buy this leg back and we'll get a little bit of money out of it. It's even doing better as we're sitting here. Or we can just do it all in one motion. So we'll just do it all as one motion. We're going to create a closing order. Nope, we're not. We're going to create a rolling order. And then it's going to call it a calendar. It's really going to be a diagonal because we're going to use different time frames here. So let's see here. It's got our 415 here. We know we're going to go out to next Friday, but we could, if somebody wanted to be real aggressive, there are Monday, Wednesday, Friday expirations with this one, okay? We're going to go out to the Friday. So we're going to go out the 22nd. We said we're going to do the 420 strike price, be a little bit more traditional here. So we're going to have a little bit of a credit as we roll it here. Okay. So we are going to take this. We're going to put it in our long diagonals bucket. And what we're hoping to see is we're hoping to see Microsoft just kind of hold its own. The last week it actually went down. It didn't, you know, when we got in, it was bouncing off the 10 here, and it's just kind of wobbled a little bit down. So our expectation here is that it will continue up, but not at a major degree. Only to a degree that maybe ideally it's only a little bit. Now, somebody has wanted to see this on the risk profile. So let me put, okay, we got hide simulations. Oh, we haven't pushed this through yet. Let's push this through our trade. Come back. Where'd he go? I think I may have lost it. So I don't think I put it through. Did it fill already? Yeah, it did fill already. Okay. Okay. Then our risk profile should be up to date. I was thinking it maybe didn't fill quite yet. I must have zoned out on the note or on the tone. Analyze risk profile. So it's showing our July 17 and it's showing our May 22nd now. There it goes. That looks a little bit better. Now it's looking better. All right. We'll put up here the 5/16 is actually what Saturday's date, and we're going to roll it out. We're going to change that to be July, although, well, we'll put it out to the furthest date out that we can. So we're going to be doing July 17. So we'll pick the 18 here. And I'm going to kind of move this a little bit. So remember this, those of you maybe that aren't as familiar with the risk profile, this kind of gives us a graphical representation of what the likelihood of movement is, okay, of this option between where we are now and this date. Now, technically today is the 14th, so I'm going to increase our calendar and let's just kind of set our prices to the break even. And it's just we're gonna take the furthest date out that it will give us. And so it is kind of saying up here is where our peak profitability is. Now, right now, that's not looking so good because of how we started out with the one that I sold being more aggressive and selling more at the money instead of selling more out of the money, okay? Our peak profitability come options expiration is gonna be right here at our strike price of 420, which is the new one that we sold. So we're going to let this marinate. If you guys are asking me questions, my chat has stopped filling in. So if you're having questions that I am not seeing on the screen, that could be the case. So I hope Barb is able to do that, to answer those questions for us. Okay, yeah, last one that our producer has is Mike's comment. Okay, it looks like a couple just came in here. Wiley's giving me a smiley face. I'm going to say that's a new comment then. Thank you, Wiley. Test for Connie. Thank you, Barb. All right, I am getting the most up to date. All right. Let's address the question of somebody wanting to do a LEAPS contract. And the way that we're going to address this is we're going to look at our current Walmart trade. Okay. Current Walmart trade. We got in these long legs the 16th of April. So we've been in about a month now, and we've sold multiple short legs against Walmart. Right now, we've got the ones that expire Friday, one more day. We're actually a little bit upside down in it. Okay, our long call has increased really nicely, so we're definitely profitable in the trade. Right here, 132 for us to close that out, to take away the risk of potential early assignment, which actually in a live account could have happened, right? Paper money does not assign early. However, we need to know that it's a possibility that it could occur, that you could be assigned early, and your odds go up when you're deeper in the money. So we're going to roll this baby. However, we are making some pretty decent money on this option right now. So the thought occurred to me, let's go roll the short leg, and then let's go roll the long leg for a LEAP contract. Okay, so let's first decide what we want to pick up here. Come over here to the option chain. Let's bring up our Walmart. All right. So that's our short leg. We're going to go out to the 22nd. Current price is about 131. So if we wanted to do something a little bit more out of the money, again, we can use our delta, which just says, you know, for every dollar that Walmart moves, this option is going to move roughly in the neighborhood of 30 cents or 34 cents or whatever our delta happens to be there. So the idea here is typically selling further out of the money, letting it decay. And so on this one, why don't we go for the 135 here? It's a 38 delta. It's got so much open interest here, which we love to see. That gives us a real tight spread here. That gives us a value of 231. So we are, then let's go ahead and just, let me write this down. The 135 is what we're going to do here. So let's go roll the short leg first. All right, here's our May 15. We're going to say create rolling order. It's going to go pull this up. It's going to buy back our short leg, and it doesn't know how far out we want to go for our next leg. So it just picks the next one, which in this case is going to be the Friday option, which is what we're going to do. And then we said, let's go out to the 135, which is about right there. If you wanted to be more aggressive, you could sell something a little closer to the money or at the money. If you wanted to be a little bit more conservative, you could sell further out of the money. Okay, we're going to go here with 135. And it's, okay. Looks like we're going to have a credit of about 82 cents here for what we're selling. Knowing that our initial trade, the one that we're buying back initially, we're down on it a little bit at this point. Our long leg's looking terrific. All right, so we're going to hit confirm and send. It's going to go back into our grouping here so we can track it. And I really want to make sure that gets filled here. What do we need to change? Maybe take a slightly lower price. Okay, we'll go down to, we'll go to 81 cents. All right, filled us now. So now let's decide, okay, what do we want to change that long leg to? We very well could just leave it in June and just continue to roll this weekly. But because Walmart has LEAPS options, which LEAPS options are, last week, it slipped my mind what we call this long-term equity anticipation securities. That's the acronym, LEAPS, so that you don't have to say that big long sentence, okay? Just means at least 9 months of time available to trade is the real definition of a LEAPS. So look at here, Walmart has a lot of potential here. So if we go 9 months forward, that's putting us into 2027. January 27 actually doesn't have 9 months, so we need to go a little bit further out. And look what we have here. We have March, we have June, we have December. We've basically got some quarterly ones way in the heck out there. Now I'm going to go on our trade here. Let's do something sort of out there, but not as extreme as to 28. Okay, I'm okay to taking it to 27. Okay. So let's go March 27. That's going to be 309 days before this expires. Okay. What strike price might we want to do? Some people might just go straight at the money, which would be our 130. Some people, when they're setting this up, might want to go in the money and be a little bit more conservative. I'm just going to go with our out the money option here. Okay. We are just going to roll it to March 17 of 2027. We're going to roll it to the 130 strike, which is our current at the money. Okay. All right. Riceburg said, the LEAPS definition, lots to learn. It's just easier to say LEAPS than long-term equity anticipation security. Yeah. Okay, let's go roll this to March 19. So this is, our other one must have not come in here. It must have gone in the unallocated. So we're going to have to maybe find it. So we're going to create a rolling order. And again, if you're not comfortable doing rolling, close one, open the next one up. Okay, just fine, not a big deal. Here's our June 125. We decided we're going to go to clear out here to March 19th, 2027. And then the strike price we're going to go with here is the 130. All right, that is our new trade. Now, because we're buying so much time, it's a more expensive contract. We are going to have a net debit here, which I would completely expect, right? Because we've made decent money on this one. So we're being able to take that credit and apply it towards this longer dated option that's quite a bit more expensive. So our net debit here is going to be 760 on this roll. Now I am going to put this up in our, well, it should go there. All right. The other one should have gone there too. All right. So that's going to be one of our newer trades, right? We're totally changing up the Walmart trade. And I should have maybe showed you the stock here. Walmart's just been kind of chugging along, being bullish, which is why we decided to do the call diagonal on that case. All right. Let's do this. Oh, I've got a comment on this, Mike. Mike said, I met a kid at the gym, 18 years old. He just started trading and made his first trade. You sent him a couple of links to Schwab classes. Perfect. We love to spread the love, don't we? You bet. I will tell you, because you mentioned that, I did teach my 14-year-old nephew when he was 14 how to trade. And he caught on really quickly. Yeah, really quickly. So the criteria for a LEAPS contract is it needs to have at least 9 months worth of time. Okay, so it has to be, and the way that I remember how many months it is, consider it a pregnancy. It's got to be it's a typical pregnancy, 9 months long. That's how long typically you need for the LEAPS contract to qualify. Okay, so that's why the March one just barely qualified. All right, next up, ooh, so many to choose from. Let's go with this one. Well, I'll look at both charts here and just kind of make sure our chart's still looking good here. This is on semiconductor, which I know semiconductors, some of them are running, some of them are getting bashed. Most of them are running right now. We can see on the MACD, it looks like, man, it just is resurging again. This was huge momentum through here, big move on semiconductor. Up here at another all-time high. So that, let's look at another one. That might be a little too far, although we could still use it. The other one I was considering doing here was Delta Airlines. And on Delta, this is what we've got going on. You can see I've drawn some lines here. The lows kind of are getting higher, but the high points are kind of finding some resistance in here. This is what we call an ascending triangle, right? And with an ascending triangle, we're expecting it. It's a bullish continuation pattern, so we're expecting a breakout to the top side eventually. We want to do it before these two lines hit an apex, is when we would like it to break out. Now, there are a couple different ways we could trade the breakout. Trade one is to see if it breaks out above this area. It's kind of in a little bit of a range for how high it was back here, $76 back in February. So it's kind of a little bit of a range. Another way we could do it is if we think there's enough room between where the stock is now and getting up there, that it's worth it. That could be a possibility as an entry as well. So on this particular one, I was looking here to do a long haul vertical. Let's go see what the strike prices look like on Delta. We're going to go out to the June 18 contracts here. Just checking my notes. Love the volume today. Love these open interest, right? Lots of open interest. We love it. Tight spreads. Makes our trading so much easier when we're not paying big spreads. Okay, makes it easier for us to be profitable closing up that gap. All right, so if the stock's at 71 or 70 is going to be our at the money here. And initially I was thinking we'd go 70. Let's just do buy vertical here. And so I was looking at 70, 72.50. And it is in a pretty decent area. Does this need to move? Yes. Does it need to move a lot? Not really. It's at 7111. We need it to move past 7250. So not really a huge move required. It could still be in that triangle, and we would still have it be beyond the short strike price that we want it to go beyond that 7250. So that's why I'm saying it doesn't have to move a whole lot. So we would be risking, let's go ahead and lock this in. We're risking $130 per contract, which is $130 for the opportunity of a net gain or a max gain here of whatever the difference is between 250 and 130, which is going to be 120. Okay, so it's almost looking for 100% return, not quite, but still a pretty decent return. Now, if you wanted to be more aggressive, you could go with the 75 here. Let's just see what it looks like if we go to 75. I've got to unlock that. Now, if you wanted to be a little bit more aggressive, 75 is up in the resistance area, kind of where this little border is here. So, we're thinking the stock is going to go up there at some point. Obviously, it doesn't have to, but we're thinking it might. So if you did want to be more aggressive on that, you could do, say, this 225 for the opportunity to gain 275. Okay, but a lot more is required out of these stocks. So we're going to just choose the 7250. Okay, that's the one we're going to go with. And now it's at $1.25. Great, we're risking $1.25 to make $1.25. Let me pull out Mr. Calculator here for just a moment. Let's see what our theoretical max gain would be here. Well, it would be theoretically what do I say there? $1.25. And if we got, let's say we got 70% again. Okay, multiply that by 0.7, then that means 87 cents of a gain is we'll be happy with. Let's add that to our $1.25. So we should go buy this back at 212. Okay, just going to mark 212 in here. And then how many contracts can we do? Max theoretical loss is 125 per contract. In our class, we can risk $2,000. So we'll divide that by 125. We can do 16 contracts here, which is why we love to see that kind of open interest, right? Again, if you were feeling more comfortable to go further out, you wanted to do the 75, you could, and then your position sizing would change on that. Let's do a first trigger sequential. Let's go buy this back, create opposite order. And we said when it gets to $2.12, we are going to be happy campers. We're not going to try to get the whole thing. We're just going to try to get a chunk of it and then be out of the picture. Let's put this in our diagonals and long verticals class. All right, I expect that one to get filled here pretty quickly. Let's see. Just seeing if there's any questions. Mike says, I told him you might be more you must become more knowledgeable. Don't you have to protect your principles so you can stay in the game, live to trade another day. Good job, Coach Mike Morrow. All right. Now, I hope that at this point you're all subscribers to our Trader Talks channel. You might not be. You might be fairly new. We have new people join us all the time, like Mike's friend at the gym. He is new. And so we want you to be able to find our content, right? If you subscribe, that little blue logo down in the bottom right-hand corner says subscribe, and it looks like YouTube. Then you can see our content, because coming up next is going to be Cameron May with investing in dividend stocks. And then let's see, Barb is on the docket for today. Barb teaches almost every day, but I do not see that Barb is on the docket today. She will be on the docket tomorrow morning with her trading a smaller account. Sounds like we just got filled. So do yourself a favor, become a subscriber. One thing that you can do here is we're doing some short bite-sized contents. I just did one this week that just barely got up where I teach you how you can create your custom columns on the Monitor tab and then use them at various places throughout the Thinkorswim platform. It's not brand new technology, but it is newer technology. All right. You guys, you've been great today. Barb, thank you so much for your help in the chat. I appreciate you. And each of you, if you want to get more comfortable with these strategies, paper trade one or any of these example trades that we've done here today so that you can get accustomed to it, so you can start doing it. Some of you, I can tell, are super engaged and I love it. I can tell you're testing it out in your own paper money account, getting familiar with how the process works and what we're considering. Now, I do hope at the end of the day, you're a little bit more comfortable here with a diagonal. We talked about that quite a bit here today. All right, take a break for 15 minutes. We'll be back here at the top of the hour. If this was helpful today, hit like on your way out. Follow Barb and I on X, Barb Armstrong CS, Connie Hill CS, and follow along on our YouTube channel. We'll see you and track these trades next week. Bye-bye.